Welcome to Advanced Tax Strategies for Estate Planning. Part 1. Introduction to Estate Planning and Taxation. Estate planning is a vital process that ensures your assets are managed and distributed according to your wishes after your passing. It's not just about transferring wealth, it's about creating a plan that provides for your loved ones, minimizes tax liabilities, and preserves your legacy for future generations. In this video, we'll cover the key components of estate planning, including wills, trusts, powers of attorney, healthcare directives, and beneficiary designations. We'll also delve into the importance of tax planning within your estate strategy to protect your assets and optimize their transfer. Join us as we explore these essential topics and help you take the first steps toward a secure financial future for your family. Overview of estate planning. Estate planning is a crucial process that involves making arrangements for the management and distribution of an individual's assets after their passing. It is not just about distributing wealth, but also about ensuring that one's wishes are carried out effectively and efficiently. Estate planning involves various legal, financial, and tax considerations to protect assets and provide for future generations. In the context of tax planning, estate planning aims to minimize tax liabilities for both the estate and its beneficiaries. Key components of estate planning include 1. Will. A will is a legal document that outlines how an individual's assets will be distributed upon their death. It also allows the individual to name guardians for minor children and to specify other important instructions. 2. Trusts. Trusts are legal arrangements where a trustee manages assets on behalf of beneficiaries according to the terms specified in the trust document. Trusts can help avoid probate, provide for minor children, and protect assets from creditors. 3. Power of attorney. A power of attorney is a legal document that designates someone to make financial or medical decisions on behalf of the individual in case they become incapacitated. 4. Healthcare directive, also known as a living will or advance directive. This document specifies an individual's wishes regarding medical treatment in case they are unable to communicate their preferences. Beneficiary designations. Assets such as retirement accounts, life insurance policies, and bank accounts with payable on death designations pass directly to beneficiaries outside of probate based on the instructions provided by the account holder. 6. Tax planning. Estate planning also involves strategies to minimize estate taxes, gift taxes, and generation-skipping transfer taxes. This may include gifting assets during one's lifetime, setting up trusts, or utilizing other tax-efficient strategies. Estate planning is not a one-time event but a process that should be reviewed periodically to reflect changes in personal circumstances, tax laws, or family dynamics. Consulting with legal and financial professionals, such as estate planning attorneys and tax advisors, can help individuals develop a comprehensive estate plan that meets their goals and objectives while minimizing tax implications. Importance of tax implications in estate planning. Estate planning is a crucial aspect of financial management that involves making decisions about how your assets will be distributed upon your death. One key consideration in estate planning is understanding and managing the tax implications that can arise from transferring assets to your beneficiaries. Taxes can significantly impact the value of your estate and the amount that your heirs ultimately receive. Therefore, it is essential to consider tax implications when creating an estate plan. Minimizing estate taxes. One of the primary goals of estate planning is to minimize the tax burden on your estate. Estate taxes, also known as inheritance taxes or death taxes, are levied on the transfer of assets from a deceased individual to their heirs. By carefully structuring your estate plan, you can take advantage of various tax planning strategies to reduce the impact of estate taxes on your assets. This may involve utilizing trusts, gifting strategies, and other techniques to minimize the taxable value of your estate. Capital gains taxes. In addition to estate taxes, capital gains taxes may also come into play during the transfer of assets in an estate. When assets are sold or transferred, capital gains taxes may be triggered based on the increase in the value of the asset since it was acquired. Proper estate planning can help minimize capital gains taxes by structuring asset transfers in a tax-efficient manner. 3. Income taxes. Income taxes can also impact estate planning, especially when it comes to retirement accounts and other tax-deferred assets. Careful planning is required to ensure that these assets are transferred in a way that minimizes the tax burden on your beneficiaries. For example, using a trust as the beneficiary of a retirement account can help spread out the tax liability over time. potentially reducing the overall tax impact. 4. Generation skipping transfer tax. Another important consideration in estate planning is the generation skipping transfer tax, GSTT. This tax is imposed on transfers of assets to grandchildren or other beneficiaries who are more than one generation below the donor. Proper planning can help mitigate the impact of the GSTT by utilizing exemptions and other strategies to minimize the tax liability. Understanding and managing the tax implications in estate planning are essential to ensuring that your assets are transferred efficiently and in a tax-efficient manner. By working with tax professionals and estate planning experts, you can develop a comprehensive plan that minimizes the tax burden on your estate and maximizes the value of the assets passed on to your beneficiaries. The careful consideration of tax implications in estate planning can ultimately help preserve your wealth for future generations. Understanding the current tax laws and regulations. Understanding the current tax laws and regulations is crucial when it comes to estate planning. This section delves into the key aspects that individuals need to be aware of to effectively navigate the complex landscape of taxation in estate planning. 1. Federal estate tax. The federal estate tax is a tax on the transfer of property from a deceased person to their heirs. It is important to understand the current exemption threshold, which is the amount of assets an individual can pass on at death without incurring estate tax. As of 2021, the federal estate tax exemption is $11.7 million per individual. Understanding how this exemption may change in the future is essential for effective estate planning. 2. Gift tax. The gift tax is closely related to the estate tax and applies to transfers of property during one's lifetime. It is important to be aware of the annual gift tax exclusion amount, which allows individuals to gift up to a certain amount each year without incurring gift tax. For 2021, the annual gift tax exclusion is $15,000 per recipient. Understanding how gift tax rules interact with estate tax rules is essential for maximizing tax efficiency in estate planning. So, Generation Skipping Transfer Tax, GST. The GST tax is an additional tax on transfers of property to beneficiaries who are 2 or more generations below the donor. Understanding the current GST tax rules and exemptions is crucial for individuals who wish to transfer assets to grandchildren or other beneficiaries who are not direct descendants. Income tax considerations. In addition to estate and gift taxes, individuals need to consider income tax implications in estate planning. Understanding how different types of assets are taxed upon transfer, such as retirement accounts, real estate, and investments, is essential for minimizing tax liabilities for both the estate and its beneficiaries. 5. State estate taxes. Besides federal taxes, some states impose their own estate or inheritance taxes. Understanding the specific tax laws and regulations in the state where the decedent resides or owns property is crucial for effective estate planning. This includes knowing the exemption thresholds, tax rates, and any deductions or credits available at the state level. 6. Tax planning strategies. Understanding the current tax laws and regulations enables individuals to implement tax planning strategies that can help minimize tax liabilities and maximize the transfer of wealth to intended beneficiaries. This may include strategies such as gifting, using trusts, charitable giving, and other estate planning techniques tailored to the individual's specific circumstances and goals. A thorough understanding of the current tax laws and regulations is essential for effective estate planning. By staying informed about federal and state tax laws, exemptions, and planning opportunities, individuals can make informed decisions to protect and transfer their wealth in a tax-efficient manner. Consulting with a qualified tax professional or estate planning attorney can provide further guidance on navigating the complexities of tax laws in estate planning. Key terms and concepts related to estate taxes. Estate taxes are an important consideration in estate planning, and understanding the key terms and concepts related to estate taxes is crucial for effective planning. Below are some key terms and concepts related to estate taxes. 1. Estate tax. Estate tax is a tax imposed on the transfer of a deceased person's estate to their heirs. The tax is based on the total value of the estate at the time of the decedent's death. Estate tax is different from inheritance tax, which is imposed on the beneficiaries who receive the assets. 2. Exemption amount. The exemption amount is the threshold up to which an estate can be transferred without incurring estate tax. The exemption amount is set by the government and may vary from year to year. Estates that exceed the exemption amount are subject to estate tax on the excess amount. 3. A taxable estate. The taxable estate is the total value of an estate that is subject to estate tax. This includes all assets owned by the decedent at the time of death, such as real estate, investments, and personal property, minus any allowable deductions or exemptions, or unified credit. The unified credit is a tax credit that can be used to offset estate tax liability. The unified credit is based on the exemption amount and reduces the amount of estate tax owed by the estate. Any unused portion of the unified credit can be transferred to a surviving spouse through proper estate planning techniques. 5. Marital deduction. The marital deduction allows a decedent to transfer assets to a surviving spouse without incurring estate tax. The value of the assets transferred to the surviving spouse is deducted from the decedent's taxable estate, reducing the overall estate tax liability. Generation Skipping Transfer Tax, GSTT. The GSTT is a tax imposed on transfers of assets to beneficiaries who are 2 or more generations below the transferor, such as grandchildren or great-grandchildren. The GSTT is in addition to estate tax and is designed to prevent wealthy individuals from avoiding estate tax by skipping a generation in their estate plan. New step-up in basis. The step-up in basis is a tax advantage that allows the heirs of an estate to value inherited assets at their fair market value at the time of the decedent's death. This can result in significant tax savings for heirs when they sell inherited assets, as the capital gains tax is calculated based on the stepped-up basis rather than the original purchase price. Understanding these key terms and concepts related to estate taxes is essential for effective estate planning and minimizing tax liabilities for both the decedent's estate and their heirs. Working with a knowledgeable tax advisor or estate planning attorney can help navigate the complexities of estate taxes and develop strategies to optimize tax efficiency in estate planning. In conclusion, estate planning is a multifaceted process that extends beyond simply distributing your assets. It involves careful consideration of legal, financial, and tax implications to ensure that your wishes are honored and your loved ones are provided for. By understanding and implementing the key components of estate planning, such as wills, trusts, powers of attorney, healthcare directives, and beneficiary designations, you can create a comprehensive plan that minimizes tax liabilities and protects your legacy. Remember, estate planning is not a one-time event, but an ongoing process that should be reviewed periodically to adapt to changes in your personal circumstances, family dynamics, and tax laws. Seeking guidance from legal and financial professionals can help you navigate these complexities and develop a tailored estate plan that meets your goals. Thank you for joining us in this first part of our series on advanced tax strategies for estate planning. Stay tuned for the next video, where we will dive deeper into specific tax strategies and tools to further enhance your estate planning efforts. By taking proactive steps today, you can ensure a secure and prosperous future for yourself and your loved ones.